Good morning, everybody. Welcome to this post-budget webinar presented by myself, Wichert Cilliers, and here from ETM Analytics, Director and Co-founder George Glynos. George, there has been a lot of talk about the budget. A lot of the positives was already in the news, like the windfall from commodity companies, better revenue collections. All of those paid through in fruition in his budget speech. There was some other stuff like there was hidden Annexure E is like foreign investment allowances for privates. Now you can take out 2 million rand on your single discretion allowance and not 1 million anymore. So now you can take out of 12 million. A lot of bracket adjustments for inflation on the tax side, but fuel levies is up, sin taxes is up. So quite interesting budget. I see a lot of people, a lot of positives and a lot of great stuff. And I said it's the first pro-growth budget that we had in maybe a decade and a half. But George, I'm going to hand over to you to see what you say and have your interesting comments about the budget. So without further ado, over to you, George.
Thanks, Wichert. And I guess I'm glad it's not Christmas, because otherwise I'd be called the Grinch. Because I didn't see this as a pro-growth budget at all. I saw this as neutral at best. They've taken on one hand, they've given back a little bit on the other, and I feel in watching the general response out there, I think that we've let our standards drop. I almost feel like we are trauma bonded to this government and the way that it conducts its fiscal policy, that we get totally excited and very happy when they don't tax us more. This is when we get excited and call it a good budget, when actually what they should be doing is cutting taxes, when they should be looking at shrinking the size of government, looking at ways to start saving and paying down debt. This is what would get me excited, because that would mean that over the longer term, we would have something to look forward to. We would have greater certainty. We would have the higher probability of being able to attract foreign capital, etc., etc. So I didn't look at this as positively as a lot of people out there did. I'll take you through my thoughts on it, but just to give you my take up front, I gave it a 4. At a push, I might give it a 5 out of 10. It doesn't deserve more than that, and I'm going to take you through it and give you a sense as to why I've said that. Bear in mind that we are moving in a better direction. So if you had watched these webinars that you and I have conducted, Wichert, over recent years, well, we started off at a 2. We progressed to a 3. Last year it got, I think, a 4. So this year we're a 4, maybe 5. We kind of creeping a little bit better, but boy, is there a long way to go. And I think at this stage of the game, I'm not going to delve into the minutiae of some of the details that you've just discussed this morning, but I am going to give you my overall take on it and give you a sense of how I think this might play out in terms of currency and South Africa's financial markets. So let's just start off with some of the pros and cons. And just to give you an idea, I didn't only look at the negatives. I've got an equal amount of pros and cons. So let's go through those, and you'll get a sense of why I thought that this might be a more neutral type of policy rather than an outright positive or completely terrible. So on the pros, we did get at least some relief that 20 billion rand tax hikes was going to be put on pause. So, that definitely got a strong green tick from me, because we didn't need those. We shouldn't be looking at taxing the private sector more, and I've got a beautiful chart to show you why that's not required. The headline budget deficit is lower than what was signaled in the medium-term budget, so I guess that would be classified as a positive. The primary surplus that's being generated, in other words, the budget balance before the repayment of debt and other unfunded liabilities has crept a little bit higher to 0.9. That also gets a positive. and the gross borrowing requirement has come down. So these are good things. That gross borrowing requirement coming down has also found expression in government issuing fewer bonds. In other words, it's needing to borrow a little bit less, which is obviously good news. We got a strong boost from commodity prices, which boosted revenues in the order of about 50 billion, and there were some interest savings of around 20 to 25 billion over the medium-term expenditure framework, largely brought about by the fact that interest rates, bond yields, have gradually come down. So these are generally positives. The infrastructural commitment, I think, should be commended. That's Operation Vulindlela. And so overall, because of all of this, there's some positives at a macro, big picture level that I will concede is a step in the right direction. The cons that I have are...
George, I'm going to interrupt you. While you start with the cons, point one, there's a question we already have, and I'm going to put the question up because that relates to con number one as well. It comes from Philip. He says, what happens to our budget if the turn in our commodity prices, including gold, despite the high commodities, these companies are still struggling with other persistent challenges, meaning that this windfall tax is not assured? I know you're going to tackle it in point one, but that's the first question. And again, if everybody has got questions, just ask them here on the right-hand side. We'll attend them as it becomes pertinent.
Yeah, so Philip, you nailed it. That is exactly my concern, is that I don't believe that there's enough consolidation in this budget. So, we tend to look at this commodity price boom as a gift. We don't see it as a long-term structural development. In other words, if you treat it as a gift, you know that it's a once-off. If it's a once-off, then you have to plan around the fact that it's a once-off. It's a gift. It's there for you to utilize at that particular point in time, not to consider it as if it's going to be here forevermore. And so you're quite right to raise that as a point, and it is my point number one. While commodity price gift is boosting revenues, I just don't think that we've utilized those revenues appropriately. Now, point number two, revenue overshoot does not appear to be structural and not bankable over the long term. So exactly to that point, Philip, that again, it frustrates me no end that we get given a gift and instead of utilizing it, banking it, paying down that debt, what we do is utilize it to fund something new. The Jafecra transfer is now done. So we've utilized the mark-to-market gains that were reflected in things like the gold price going higher. In other words, the funds that were sitting in the Reserve Bank's reserve account, which essentially is the country's reserves account. We tapped into that because apparently it was more than what we needed. And so we've pulled money out of that. Again, tapping our reserves to fund short-term expenditures, not a good idea. Our debt to GDP ratio is still rising, notwithstanding these windfalls, notwithstanding these gifts and the Jafecra payments. Our debt to GDP ratio, the peak of it, has risen again. And I reiterate the point that year after year after year, we see these beautiful pictures, and I'll show you one in a slide or two, where they constantly talk about that debt trajectory, peaking and dropping off. And it never does. Year after year, it just seems to creep higher and higher and higher. And it's happened again. So I don't like to see that. Real expenditure has continued to rise. In other words, they have increased expenditure at a rate faster than inflation. And you ask yourself, well, where are you going to get that money from? Well, if it's not going to be from commodity prices down the line, it means that they're going to have to tax the private sector more in order to fund that. The fiscal anchor, there was a lot said about a fiscal anchor, but it seems like the way that they've described it is that it's so ideological. We think that it amounts more to guidance than it does a numerical rule that we can really bank on, and that's going to hold politicians to account. So at this stage of the game, I'm not reading too much into that. The overheads of government have been extended, and you can see that in the real expenditure that has risen beyond inflation. And so as a result of all of this, I don't see any possibility that South Africa's credit rating is going to get upgraded. Now, if you, like me, took the finance minister at his word when he turned around and said that they were targeting at getting South Africa back into investment grade within 2 years, you would have had very, very different expectations for this budget. For starters, you would have wanted to see debts actually getting paid down. You would have seen the interest on debt coming off a lot more sharply than it is at the end of the day. You would have wanted to cut bond issuance even more than what they're reducing it by. And so ultimately, that's, I guess, where the biggest frustration sits. So South Africa's problem, in a nutshell, is that we're dealing with a credit rating, and we're the purple line at the bottom, which has dropped precipitously through the Zuma era into Ramaphosa's era, where it has stabilized a little bit. You've got to look for a budget. You've got to look for shifts in the ideologies applied to these budgets that's going to get that purple line to start going back up again. In other words, looking at credit ratings upgrades. I don't see enough in this budget that would tell me that a credit rating is about to move in that right direction. And it doesn't give me any comfort that other countries around the world have also suffered credit rating deterioration through the course of time. South Africa needs to be doing something a little different. So if I have a look at a little bit of the breakdowns of government revenues versus expenditures, there's one thing that stands out for me. We have become far too comfortable with the level of expenditure that we currently have. We've become too comfortable with a bloated budget. We've become too comfortable with the levels of inefficiencies that we require. If you just have a look at the chart on the right, and I highlighted the golden period. That was when President Mbeki was in office. It was when we had Trevor Manuel as the finance minister. And you'll see that your gross expenditure as a percent of tax revenue was pretty close to the 1, and then briefly went below 1. In other words, on a ratio of 1 to 1, you were nicely balanced. What you don't want to find yourself in is in a position where essentially your expenditure is constantly increasing at a rate higher than what your tax revenues are increasing at. And so we need to be seeing that blue line dipping along the lines of that arrow back towards the 1 ratio, but it never seems to do that. And it's been like that for the better part of almost 20 years now. So frustratingly, we've gotten used to this level of expenditure, and you can see it reflected in the chart on the left. So the chart on the left, if you have a look at the blue line versus the black line, you'll see that blue line rose. And instead of just keeping that black line horizontal, I'm not even suggesting that they needed to cut aggressively, but if they could just have kept expenditures horizontal, such that we could close the gap between the blue line and the black line, that would have made a big difference. But the minute that blue line rises, they use it as an opportunity to spend more. And so it speaks to this climate and environment of weak fiscal discipline. And that weak fiscal discipline over time tends to result in burdens that need to be carried. Reflected in a slightly different way, and I always find this a fascinating chart, because if you have a look at this chart and you focus specifically on the 2007-2008 period, again, that's the golden period where we had Trevor Manuel in power, where we were running a budget surplus. South Africa at the time, if you recall, was running GDP growth rates of 6% and above. We had a debt to GDP ratio of around 25%. Those were the good times. And the reason they were the good times is that we weren't reliant on government to do any of the heavy lifting. At the point where you adopt this socialist type mentality that it's always government that needs to come to the fore, what you don't realize is that by doing so, you're injecting a high degree of inefficiency into an economy, for the simple reason that government doesn't operate with a profit motive. It doesn't care about efficiencies in the same way that the private sector does. So the more that you rely on the public sector to do some of the heavy lifting, the worse the feedback into the economy is. Your multiplier effect drops substantially. In other words, for every rand that gets spent by government, you actually get a negative multiplier. For every rand spent by the private sector, you get a positive multiplier. And so what lands up happening is that the more that government spends, and the more that it does so inefficiently and exposing itself through corruption and all of that sort of stuff, the more the private sector is forced to shield and hedge itself against the negative the negative fallout that'll come from a government that is becoming too bloated, is too much of a burden on the private sector. So what does the private sector do? It naturally starts to hold back on the deployment of capital, and those savings rates tend to rise. You saw that happen very, very aggressively through the beginning of COVID, again, proving the point that whenever you get high degrees of uncertainty, private sector tends to pull back. So the ultimate objective here would be to try and shrink the size of the government sector, get that black line to move up. In other words, it becomes less of a dissaver. And the less dis-saving that a government does, the more the private sector is likely to feel inclined to deploy their capital into the economy. So you see these sort of this big mirror image that's taking place at the moment. And this data is publicly available. It's there for everyone to see. And I sometimes wonder whether our authorities pay attention to things like this, because if there was ever a reason to back the private sector over government, this chart would be one of them. But I've got a few more to show you to just prove that point. So where does that leave us? Well, we've unfortunately gotten a further upward shift in the debt to GDP outlook, and that's the chart on the left. Again, just to reiterate the point, when we were looking at the medium-term budget in November last year, we were supposed to be peaking just under 78% and then gradually drifting down. But once again, that line has just gone up and ratcheted up again. So now apparently we're peaking at 78.9. So we're peaking at effectively a full percent above what they were anticipating. And that's despite the fact that we've had commodity price windfalls, despite the fact that we've used the JAFECRA funds and all of that. So it's frustrating to see this, because as you see from the left-hand part of that red line, at no stage has it shown any signs of materially slowing down. Okay, maybe in the last iteration, it's the trajectory is just flattened ever so slightly, but it's still going very firmly up. And what we are told now is that we need to believe them, that actually they have got control over the fiscus and that this is going to turn around. Well, until I see it physically turn around, I don't believe them at this point. I simply don't believe them, because they've got a bad track record in this regard. A similar sort of picture arises out of the debt service costs, although on this front, we have seen a mild turnaround. And that's very much a function of South Africa getting off the grey list and getting a credit rating upgrade off a very low base, I must add, which ultimately resulted in a flood of funds back into the bond market. And that flood of funds back into the bond market has helped reduce bond yields. And those bond yields have resulted in a saving that has translated into debt service costs as a proportion of the budget actually just coming down a little bit. That's a positive, but it could have been so much more. And again, it just speaks to that wasted opportunity. But this is the chart that bothers me. And this is the chart. It's the reason why I get so frustrated when I see some of the other commentators out there giving budgets like this a 6, 7, 8 out of 10. It frustrates me no end, because when I see charts like this, I just want to cry. Essentially, what we've done is we have just loaded up households and personal income tax to fund all of the underinvestment, the maladministration, the bloated government that exists. And so whilst you see the tax collections from corporate income tax, value-added tax, and others are generally trending a little bit lower, that gets made up by personal income tax as a proportion of the tax collections steadily rising. So we're just leaning more and more on households, and the more we lean on those households, the more difficult it is to get this economy's dynamism moving again, which is of course frustrating. Equally frustrating is that we hear all about this 1.07 trillion that's going to be spent into the economy over the next 3 years. Wonderful. I'm all for it. Operation Vulindlela speaks directly to it, and I'm a big fan of Operation Vulindlela. But Vulindlela on paper is one thing. Vulindlela in practice is another. And I'm still waiting to see these numbers come through in the gross fixed capital formation. In other words, the fixed investment as a percent of GDP. Again, it's a case of show me the numbers, show me the proof that the investment into this infrastructure is indeed taking place at the pace that we need. Back in the days of Trevor Manuel, he often spoke about the need. And if you recall, he was the author of the National Development Plan along with his team. And at the time, if you go and look in the National Development Plan, you will see they would have been targeting fixed investment as a percent of GDP, hovering around the 30% mark. And they were well on their way to doing that. And then suddenly we had the global financial crisis, and we, of course, had the Zuma administration that took over shortly after that. And all that good work that we had established and started generating, in other words, that fixed investment as a percent of GDP rising very, very sharply, which was generating so much positive feedback into the economy, quickly reversed, and we've just never recovered from them. Well, we are told that we are trying to boost that fixed investment now. We're told in the budget that there's over R1 trillion to invest, and yet the number tells me another story. And when you have a look at the breakdown, once again, it's the public corporations and general government that have been the laggards. It's the private business enterprises that have done the bulk of the heavy lifting, and yet that's where the tax burden sits. The tax burden sits in the orange line, and you sometimes wish that government would just get out of the way sometimes and allow the private sector to do just so much more of the heavy lifting. In theory, that's what Operation Vulindlela is supposed to be about. Operation Vulindlela is supposed to shift some of this fixed investment spending and push that across to the private sector to do. In other words, allow private capital to invest into some of these network industries such that we could get the economy going. And yet, it just never seems to be the case. And then, of course, you have to try and pull away some of the curtains that government put in front of these government finance figures to make things potentially look a little bit better than they really are. So if you do just a very basic exercise of taking these government figures, and to that you add what they call contingent liabilities, and to that you add things like municipalities, to the debt pile that government is carrying, suddenly you find that South Africa's debt pile isn't sitting at just under 80% of GDP. It's sitting closer to 100% of GDP. And that's not a forecast, that's an actual figure. So the debt figure that we are sitting with right now is not looking as rosy as it gets painted out. The fiscal discipline I haven't yet seen fully. In fact, quite the opposite. That black line, which is the actual number, is still on a very firm, solid, upward rising trajectory. It's just the forecasts that keep coming down. But they've been coming down now as a rule of thumb in every single budget produced, going back all the way to 2010 and even prior to that. So this is smoke and mirrors, if you like, until such time as you deal with the real issues, which is sorting out municipalities such that they don't need to get bailed out, sorting out contingent liabilities such as Eskom and Transnet and all these other SOEs that require bailouts. Until you sort those things out, the real situation, the real debt levels of this government sit closer to 100% of GDP rather than the 80% that you see in this data. And you can kind of reflect the point that I'm making when you have a look at the net loan debt as a percent of GDP on the right, and you see that the estimates, the forecasts, and these aren't long-term estimates, they were the short-term estimates, which you would expect them to be a little more accurate. You see these little offshoots on the side. Those were the estimates that were given all the way through that process. And they always tend to be a little bit lower, say for a period during COVID where they really didn't know what to expect. The rest of the time, those offshoots are all lower. So they're always more optimistic than reality tends to be. And so again, I would hazard a guess that it's going to be more or less the same. And so, against this backdrop, it seems kind of counterintuitive that we've got a presidential policy scorecard that's improved and overall macroeconomic conditions that appear to have improved. But you need to take a little step back from this and just understand that in a little more context, because there's a lot of cyclicality to this, which has precious little to do with what the government's talking about and doing. And what it really is about is the effects of this big commodity price boom that has boosted a lot of mining companies, that have paid out a lot of dividends, that has boosted the JSE. The wealth effect of that comes through. On top of all of that, you've had South Africa get off the grey list, get a credit rating upgrade. The GNU has survived. You had a budget that wasn't entirely irrational. So all of these de-risked South Africa, and you got inflows back into SA markets, which boosted the rand, and a stronger rand leads to lower inflation, and a lower inflation leads to lower interest rates. So there's a big cyclicality to all of this. But I think the point that I wanted to make by this is that you have this opportunity where things are growing a little bit better than they have in a while. What you do when that is combined with a gift, you bank it. You save for a rainy day. You take those gifts. You say thank you very much. You pay down the debt that you should have been paying back a long time ago, and you say thank you very much for that opportunity to just give me a little bit more breathing room. And yet, frustratingly, that's not what happened. Equally, we're still sitting with this, growth forecast pathology, if you want, where it's almost like the 1, 2, 3 principle. Where do you start with your forecast? Well, you kind of just draw it upwards. Just whatever you do, just draw your growth projection upwards. Probably a good 8 times out of 10, these maybe bordering on 9 times out of 10, these forecasts prove too optimistic, and most of the time are proven wrong. We're back in the same movie again. And so once again, even though they've lowered the trajectory so that it looks a little more realistic, and some people give them kudos for a more realistic growth assessment, I look at this and I'm just thinking, just more of the same. If you have a look at it through the course of history, it would be fascinating for me to see a really flat trajectory to say, geez, guys, we buggered this one up. We've got to change our policies fairly significantly to try and get this number up, but this is what's required. I haven't seen that. It wasn't evident in this budget. And so, some of the opposition parties came out and complained that this wasn't, a growth supportive budget. I would go along with that. I didn't see anything in here that got me particularly excited that everything would turn around. And all of this is happening against what looks like the potential for a global backdrop that is becoming and looking a little more fragile than it was a short while ago. Recall that this chart doesn't guarantee that there's suddenly going to be a crisis, but it certainly raises the probability that there might be one. And so when you can see that there are global headwinds that are blowing, and perhaps blowing a little bit stronger than you want, the first thing that you need to do as a prudent government is utilize any windfall that you get right now to buy yourself a buffer against some sort of calamity happening. Because at the point where calamity does happen, and it will happen, I mean, it's just business cycles, and nothing is ever fixed and perfect forever. At the point where that crisis suddenly happens, you're going to be scratching your head saying, how were we so unprepared for this? Where did this come from? And you're going to hear people talking about black swan events and whatnot. Well, the best way to protect yourself against the unknown and black swan events is to turn your balance sheet more conservative. That goes for governments just as much as it does for households. If you foresee trouble brewing in the future, the one way to shield your household against that is to make sure that you've paid down as much debt as possible, that you're living well and comfortably within your means, and that you have diverse revenue streams such that you can weather the storm until things start to improve again. The same principles apply for a government, but yet we never see it applied to any significant extent. So the RAND reaction to this budget peculiarly was positive. But the question I want to ask is should we trust this positive reaction? And I'm left with the question, of why it might have responded so positively in the first place. Is it that there was so much negativity that was just inherently baked in, that we've gotten used to as a market, that foreigners have looked at this and said, oh no, this was actually less bad than what we thought, or slightly better than what we thought, therefore we can jump back into South African bonds, for example. Well, bonds might be one of the answers, because right at the end, just after the budget speech was given, we heard news that suddenly National Treasury was going to be issuing a lot fewer bonds into the open market at their weekly auctions, and all of a sudden there's this perceived scarcity of bonds, and suddenly the bond market's strengthening, and the rand is doing a little bit better. Well, that might explain that. But if that is one of the reasons why the rand responded in the way that it did, it's a very short-term thing. And so we might see that reversing in the next week or two. Also to say that whilst the rand has strengthened, just bear in mind that it's not out of kilter with what's been going on elsewhere in the world. And I think that's important, because sometimes we get so caught up in the singular performance of the rand that we tend to lose a little bit of context and not realize that in fact there are other emerging markets that are performing a lot better. But this is the chart that I wanted to highlight today, because we ran this just yesterday, and it is our rand sentiment indicator, which we utilize as somewhat of a leading indicator to the rand. It gives us a sense of the kind of hedging behavior that corporates and professional traders are exerting in the open market. So we're not posing questions and asking them what it is that they feel and think. We actually tracking what they're doing, and we can see that from the pricing action in things like the options market. And we noticed that risk reversals have moved very dramatically in the past week or two. Specifically now, recently, they've moved very aggressively, suggesting that foreigners that have bought into South Africa are now starting to hedge themselves against rand weakness. And so there's a general feeling in the market that's growing that suggests that the rand might be a little extended at these sorts of levels. And certainly when we have a look at our valuation metrics, and we have a look at the dollar in particular, you can see that it has stretched far beyond its statistical norms. It has moved to a point where it can well and truly be classified as extended beyond what we have seen over the past few years. And so we pay attention to that. What it means is that importers should be looking at this as an opportunity to take advantage of. But it also means that a rand at these sorts of levels might not be sustainable for particularly long. Interestingly, when we look at the likes of the pound and the euro, it's less significant. In fact, against the euro, we're pretty close to fair value. Against the pound, only slightly undervalued. But I think the point still remains that against the dollar in particular, the rand is looking a little bit stretched, and we need to be mindful of that. So, where does that ultimately leave us? I've given you a little bit of perspective on rand and why I think there are enough reasons in this budget to not have these sort of rose-tinted glasses that rand is just going to continue powering ahead and powering ahead and powering ahead. It could go a little bit further. There's momentum behind this market, and there is some foreign buying into South Africa that's assisted that. But I think we're now starting to approach the tail end of this move. We may be in the last quartile of the move, so to speak. So there may be a little bit more, but that's the sort of time when importers should be looking at this and saying, "Ooh, nice opportunity for me to finally be able to hedge myself at more competitive rates." What that means is we still got inflation that remains nicely under control, partly because the rand has been as strong as it is. I think things could have looked even better from a monetary policy perspective if this government had just adopted tighter fiscal policy. The Reserve Bank would have had more room to reduce rates even further. So there's another bit of frustration, I guess, that we might all feel from this. But overall, that's my take on this budget for the time being. I would I guess, give a caution out there that I don't think this was as positive as many of the as many of those of my colleagues in the market have put it. I see it, like I said, neutral at best, maybe even slightly below 5 out of 10. And I think there's a lot more that could have been done, which ultimately means that we need to be wary of this kind of level of rand strength that's coming through the market. It may not be as sustainable as we may have just automatically assumed by virtue of the fact that commodity prices remain elevated, etc. So with that, Richard, I'm happy to open up and take questions from anyone.
Yes, we've got a few questions. I'm going to put them on the screen for us. So again, Phillips asked, the budget, when combined with the President's SONA, appears to be an advertising campaign in advance of the local government elections as the ANC is under pressure. Does this give us any leading indicator of a policy shift towards a more moderate economic policy and abandonment of policies which are negative to economic growth?
Yeah, I mean, it's again, Philip, quite right to raise that. I think it's a valid point to make, and we have tended to see when the ANC is under pressure and searching for relevance and wanting to keep themselves popular with their voter base, they tend to become a little looser with the purse strings, and I think this has happened again in this budget. It's not as easy to see in this budget because the numbers, the expenditure numbers haven't blown out of all proportion. So they seem to have just restrained themselves just a little bit. But I think you are spot on. I do think this is in part related to the upcoming elections, and for that matter, I think other members of the GNU are probably in the same boat. They didn't want to have to face questions as to why they're being so fiscally tight, just as they're all looking to try and capture some votes. They want to be part of a GNU that people look at as being supportive of their household finances and whatnot. And a lot of the detail that Richard was referring to before we got started here was about that. They didn't hike VAT. They didn't raise the tax burden on households anymore. They did give a little bit back in terms of to adjust for bracket creep and the likes. They did raise some of the limits on being able to take money abroad and pension allowances and things like that. So they did raise things a little bit here and there, but again, it's like I said, it feels almost like South Africans are trauma bonded, that we get excited when they don't do something punishing towards us. We get excited and call that really positive and good news. Actually, I mean, we should be expecting so much more from this government, and it frustrates me that we don't.
Yes, George. Then we've got another interesting question. There's been a lot of speak about the process of phasing out and ceasing use of the prime lending rate by the SARB's proposing. What are the benefits attached to that?
Yeah, I don't know. I don't know that there are any, to be honest. Banks are going to price themselves at whatever rate their credit assessment of a household or a person is. Whether the prime rate's there or not, I think is largely irrelevant. We've got, possibly more interesting is the shift to Zeronia from repo, and that's in the mix. That's going on in the background. That could have a slightly more influential impact on interest rates. But for your average households, I think the biggest shift is going to be how the legal documents and the legal contracts between households and banks, for example, adjust for shifts without a prime rate, a physical prime rate being mentioned. And traditionally, banks price this amount above or below prime, depending on your regardless. Whether the prime rate is is there or not, I don't think makes a huge amount of difference.
George, and another question from Julian is, what is the risk that South Africa's economy may overheat if both fiscal policy and monetary policy become expansionary?
Yeah, we've got a very prudent Reserve Bank, and I know the people there. They've got good heads on their shoulders. In fact, I'd say we've got one of the better central banks around the world, and so the chances that I think are very little. The unfortunate reality is that our fiscal environment is so constrained that I don't believe there's any chance whatsoever of South Africa overheating. In fact, we're carrying such a burden that we couldn't overheat even if we wanted to. So the tax burden is just too high for South Africa's economy to be overheating. The kind of what they frame as a stimulus in terms of expenditure of 1 trillion rand into infrastructure over the next 3 years, again, it's just smoke and mirrors. You should have been doing that as just normal course of business in any responsible government. The fact that they're kind of highlighting it now, it's more of a marketing spin to put on something they should have been doing regardless. So, you've got to be careful about how you understand and read the way governments communicate with the open market, because quite frankly, they like to twist the reality to give it a sense that they are coming to the rescue of this economy, when actually they are the root cause or the reason why we are not growing at 3, 4, 5, 6%. What I'd like the government to do, and where it might become possible for an economy to overheat, is if the government shrank substantially, deregulated, and allowed the private sector to do a hell of a lot more across a whole range of industries. Vulindlela goes part of the way to allowing the private sector to play a significant role in running what they call network industries, but even better would be if we privatize some of these industries outright. But that's just not going to happen whilst the ANC has any form of control over this government, because it's not their ideology. It's just not the way that they choose to run the economy. And so I don't think there's much chance of South Africa's economy overheating at all. In fact, the frustration that we suffer with at the moment is that it's just not growing enough.
And then just, George, lastly, I'm going to end off the rand. I'm going to also add something to it. This is ask what would be the impact on the rand be if there's a sharp global downturn, i.e. the AI bubble bursting. And then just to add on to that is, obviously the rand's been strengthening because there's a lot of foreigners buying our bonds. But we must also remember that there's coupon payments on those bonds that the government needs to repay. That's outflows out of the country again. That also will put pressure on the rand, if I'm correct in stating that. So that says, so the rand has strengthened 18%, but to do another 10% from here, do you agree it will be difficult?
Yes, I do agree that will be difficult. And the question that David posed there is a very important question. It's the reason why I was a little less sanguine on this budget, and why I wasn't as optimistic as many others out there, is because I've been around the block unfortunately too many times. I've been covering economics for over 30 years, and in that time I've seen many cycles. I've seen booms, I've seen busts on more than one occasion, and they come, and you can think that a situation is nice and steady. But these big corrections in financial markets do arise from time to time. And again, that's the point that I've been making throughout this presentation, is that you should be utilizing whatever windfalls, whatever market gifts you get given to pay down debt and to make yourself less vulnerable to some of these international shocks. Because when those shocks come, and they can be really, really violent, you do get this big sucking sound out of emerging markets. The rand will undoubtedly get hit, just as it has on many occasions previously. And people are going to be sitting back wondering, oh, why pick on South Africa so much? Well, we had a choice, and the choice could have been to leave ourselves a lot less vulnerable to some of these shocks, but we chose not to. And I think that's something we've got to remember. So there is a risk that there is some sort of an AI bubble, whether it's an AI bubble or a tech bubble or just a general debt bubble, because there's debt everywhere in the system globally. There's another fresh record that was produced by, I can't remember if it was the World Bank or the IMF, produced a global debt level of $384 trillion now. This is what global debt levels have risen to. It's staggering. It's such an enormous amount that it's almost difficult for anyone to fathom. And so there are lots of potential reasons why there could be a major financial market correction. And whilst that is the case, I think it's generally more prudent to run more conservatively and run with the smallest possible overheads that you can. So in answer to your question, David, if you get a big correction of that nature, South Africa will suffer, and this budget doesn't help us protect from that in any way whatsoever.
George, that is the questions for the day. For anybody, I just want to say thank you for giving us such an insightful view into the budget and what's happening out there. For anybody that's listening, if you got any further questions or things that you need to George or ourselves to attend to, please feel free to pop us a mail and we'll get around to it. But for now, I want to say thanks to George again. Thanks for everybody attending. Enjoy the Thursday and enjoy the weekend, and we will be back again. Thanks, George.
Thanks, everybody. Have a great time.